Hi everyone, my name is Dave, and welcome to Breaking Chart Alert's first beginner class. Today I'll be helping you to understand stock options. So let's start from the very beginning. If you just decided to start trading and you've heard about stock options, you're probably feeling a little intimidated. Let me help you out then. Let's go straight to the big questions. What are stocks? What are stock options? First, let's talk about stocks. Stocks are basically a fractional ownership of a company. So, a company like Microsoft, Netflix, Tesla, Apple, they sell shares of their company to raise money. Each share is worth a tiny piece of ownership, and as the company becomes more valuable, the shares become more valuable as well. So, if you buy a stock at one price and the price goes up, you make money. If you buy it and it goes down, you lose money. It's really that simple. Now that you know what stocks are, let's talk about stock options. Stock options are contracts that, when purchased, give you the right but not the obligation to buy or sell a stock at an agreed price and an agreed expiration date. To put it simply, they are a way of controlling chunks of stock. Each option controls 100 shares of stock. An option is a contract between the buyer and the seller, where you buy or sell control of 100 shares of stock, essentially by putting a deposit or option premium down in order to hold that price for that strike price for a certain amount of time, known as the expiration date. Now that we've learned what stocks and options are, let's talk more about options. There are different kinds of options that you use for different market scenarios. One of them is a call option. You buy a call option when you think the market is going to go up. A call option is a contract between two parties to buy control of a stock at a certain strike price by the expiration date. So if you buy a call option, you put down the payment or option premium to hold that price, even if that price goes up later. If that stock price does go up, the buyer can then sell that option for a profit. So the buyer of the call has the right but not the obligation to buy the stock at the strike price in a future date known as the expiration date. The other party, the seller of the call, has the obligation to sell the stock to the buyer at that agreed upon strike price if the buyer exercises that option. Wait, don't panic. I know it can sound very confusing, especially if you're new to all of this, but I'll make it easier for you. Let me give you an example so you can understand how it works when applied to real life. This is Mike. Mike wants to buy a house, and this is Lisa. She is selling her house for $100,000. This $100,000 will be our strike price, but he won't have to pay that full amount for a month, the month being our expiration date. So he makes a deal with her, and he offers her $5,000, which would be our option premium. If she takes her house off the market right now until he has that full amount. So this deal gave Mike the right but not the obligation to buy that house for $100,000 anytime during that next month. During this month, it's announced that a mall is going to be built right by that house. This makes the value of the house increase, and Mike's friend Jake tells him that he'd be willing to pay $150,000 for this house. Mike then accepts the deal from Jake to sell the house to him for $150,000. With the $150,000 that Jake paid Mike for the house, Mike uses $100,000 to pay Lisa like they agreed on. Now that Mike has made a $50,000 profit on that transaction, Mike paid the $5,000 to Lisa to hold that original price. So his final profit is a net profit of $45,000. That transaction was a call option. He profited as the price of the house went up. He had the right but not the obligation to buy that house at that price within that 30-day. Let's say Mike walks away from the deal, or the price of the house goes down instead of going up. Then Lisa would just keep that $5,000 that he paid her to hold on to the house for that 30 days. And that is the max that Mike could lose on this deal. Now that you understand how it works in real life, let's define it in trading terms with a real trade example. Let's say that XYZ Corporation is trading at $100 a share, and you think it's going to go up to $120. So you buy a call option for a price of $1 for each contract at the strike price of $110. Like I mentioned before, one option contract controls 100 shares. So you'll pay $1 times 100 shares, which will total $100 for that call option premium. Let's say the stock does go up to that $120 per share after you buy it, from now until that expiration date. Since you bought that call option for the 110 strike price, you have the right, but not the obligation, to buy it for $110, even though it's selling right now on the general market for $120 a share. That gives you a $10 profit on each share. But remember, you paid $1 per share for that option. So now that you made $9 on each share, $9, multiply that by 100 shares, that's a $900 net profit on each of those contracts. So let's do the math. You bought an option for $1. Each option controls 100 shares. So you multiply 1 by 100, which gets you $100. That's what you paid for that contract, or known as your option premium. Your profit was $10 per share. So 10 times 100 equals 1,000, right? So you profited $1,000, but you paid $100 for that option. So you ended up with a $900 net profit on that trade. Now you may ask, what if the market never goes up? In that case, the call expires worthless. Just like in our house example, if the deal doesn't move forward, the seller keeps your contract fee or your option premium. So if the call option never goes up or even goes down, your maximum loss is the amount you paid for it. So in this XYZ case, $100 is your max you could lose on this trade. The other kind of option is a put, which is the opposite of a call. It gives you the right, but not the obligation, to sell 100 shares of stock. You buy a put when you think the market is going to go down. A put is a contract between two parties to sell a stock at a strike price at a certain expiration date. So if you purchase a put option, you put down a payment or option premium to hold a certain stock price, even if that price goes down later. If that price does go down, that buyer has to give you that original price if the seller exercises that option. Let's go to another example. For this one, we'll bring in Liam. What's going on, Liam? Liam owns an excavator that is worth $50,000. He uses it to work, so he's afraid it'll get damaged. He decides to buy a zero deductible insurance policy, our put option, for the full amount of $50,000, the strike price, from Jenny's Auto Insurance Company. She charges him $2,000, which would be the option premium, for a 1-year policy, 1 year being the expiration date for this option. During this year, Liam's excavator gets damaged, requiring $10,000 worth of repairs. He exercises his insurance policy, the put option, and his insurance covers the $10,000 as agreed. So instead of paying $10,000 for the repairs, he only paid $2,000 to purchase that policy, the option premium. So he saved and profited $8,000 from this deal. If the circumstances were different and Liam never had a problem with the excavator, the only money he would have spent would be the $2,000, the option premium, that he paid to Jenny's to purchase that insurance policy. Now let's bring Liam's example to trading terms. Remember XYZ Corporation? Let's say it's trading at $100 per share and you think it's going to drop down to $80 a share. So you buy a put option for the $90 strike price for $1 per share. If the stock drops to $80, that would allow you to sell your stock at $90, even if it's valued at $80 now. And remember, you're making money on puts as it goes lower. This would give you a $10 profit on each share. But like before, we have to subtract what you paid for your option premium. So you paid $1 for each share. 10 minus 1 equals 9. So now your profit is $9 per share. And since there's 100 shares in a contract, you're simply multiplying that $9 by 100 shares, which gives you a total of a $900 gain. If the put option you bought never goes down, the option expires worthless, and you only lose the $1 per share that you paid. Okay, so to recap, a call option could be compared to a down payment to buy stocks, and no matter how high the price goes after that, you have the right to buy those stocks for the price you agreed on when you paid the down payment for that expiration date you choose. A put option could be compared to an insurance policy for your stocks, so that assures you no matter how low the price of your stocks go, your insurance company has to buy your stocks at the price you agreed on. Thank you for joining me for this lesson. I hope you learned the basic of stocks and options and realize that when used correctly, you can earn big profits. Join me on our next class, and I hope to see you there.